Hi there, I'm Lindsay Biscaya. Every 2 weeks on Wednesday, we are diving deep into the world of options trading, exploring the fundamentals of puts and calls and how you can effectively incorporate them as an investing tool to maximize your returns and manage risk. You can call us toll-free this half hour, 1-855-326-6266, or email us at knowyouroptions@bnnbloomberg.ca, and we will answer your questions. And we're going to bring in Thom, CEO and Portfolio Manager at Moat Financial, joining us in studio. Hello.
Yes.
Good to have you.
Yeah, great to be here.
Okay, so the theme of this show may be a bit surprising to some people. Today you want to talk about options, meme stocks, sorry. And I think before we get into this, maybe just explain to our viewers what exactly classifies as a meme stock.
Yeah, so I mean, the main thing, I just want to talk about options that have like really crazy high implied volatility, which meme stocks fall into that category. So, I did my write-up for this last week, and at that time, GameStop hadn't sort of re-entered the picture, but now obviously they're bidding for eBay, but they're sort of the original meme stock when Roaring Kitty was getting everyone to buy options and pushing up option prices to levels that just are very rarely seen. And, meme stocks, when they go crazy, have these big moves in the market. Their options often have like an even bigger move.
I know GameStop kind of seems like the poster boy, if you want to call it that, of meme stocks when it first came out, right?
Yeah, absolutely. I mean, it went from basically bankrupt to getting tied into a short squeeze and then going through the roof. And, there's movies made about it. That's how big of a cult hit it was. So the options on that, they're not as crazy as they once were. It's a pretty different company now. But just for the record, we are not recommending anything to do with GameStop here.
I was going to say that. Yeah, you're not giving any recommendations here. We're really just talking about it. So I don't know if you want to start with some examples, other examples of what you mean and what you want to talk about.
Yeah, so this year we've had a few stocks that have just gone wild to the upside, and the option prices have done the same thing. So if you look at Avis Budget, the car rental company, they ended up in a short squeeze situation where the stock went from like around the low hundreds up to around $850 in just a couple of weeks. So with a move like that, the option prices, they went through the roof, and the stock has settled right back down to around 160. So you can see that move in the chart there. And so, I mean, when the stock was trading around 600, I mean, you could sell the $300 puts for like $60. Now that the stock has settled in back to around 160, you can sell the, again, not recommending this, but you can sell the $100 put. So something that was $700 out of the money just a couple of weeks ago, for a couple of bucks, just not really going out that far. So the implied volatility in these options is like 10x what the broader market is.
Why? Like, why the volatility? Look at that spike there. That's pretty crazy to see.
Yeah, I mean, I guess this one, it ended up being a big short squeeze. So there was people who were short the stock. I mean, their balance sheet is not something that other companies will be rushing to emulate at this point. So people were betting that it was going to go to zero, and then they got caught. Stock started moving up. They had to buy the shares, but it was controlled by, a small number of parties. And then what happens is if a stock can't be shorted or it can't be borrowed to short, the option prices can really go crazy because market makers, in order to hedge themselves and remove their risk from the positions that they're putting on in order to provide that liquidity, if they can't short it, then prices just blow out. And that's what happened there.
Interesting. I mean, it's all just hype, right? Like people hyping up a company or a stock, and that's kind of what happens.
Yeah, or you've got someone who's forced to buy that stock back, and there's not a lot of liquidity.
Okay, so how can someone actually profit off of this? Again, not recommending anything, but if someone's interested, like what's the route you would take?
Yeah, so the challenge with these is, if you want to make a directional bet on one of these and you buy the options, we always talk about how hard it is to buy options because you have to get the timing right, the direction right, and the amplitude right. But when the prices blow out like this, that amplitude becomes a really big thing. So the way we do it is, we are constantly combing the market, looking for opportunities, looking for things that have a high implied volatility. So you can just Google, like, what is the highest implied volatility stock right now, and you can see a list. Unfortunately, most of the time that list is full of things that we don't want to own, some speculative biopharma stock or something, like an Avis Budget that's gone way up. But if you can see on these lists something that you are willing to own for the long term, and you can find an entry point that you're willing to buy that stock, then that's when you can take a look at selling some puts and saying, okay, if this pulls back to where it was before with these elevated option prices, like, am I willing to buy the stock if I have to? Or if you're fortunate enough to own one of these names, you can start selling some calls. So you may be forced to sell it if that rally continues, but trying to harvest or capture that premium is a great time to do it.
And as you say, there's a lot of names that you wouldn't own. So it's obviously a personal preference, and you're staying away from some of the more volatile stocks, or what are you kind of what do you like to stay away from, I guess?
Yeah, something that, our investment philosophy, we're value investors at heart. We use some option trading to get involved with our systems. Mm-hmm. But if the company is trading at a crazy high valuation, then we're unlikely to want it. So, sometimes we do come across some of these names where they do make it onto some of these high volatility lists. Lululemon has been one that right. It hasn't been working, but the option prices are very high. And we're happy to sell that as the stock has moved down because the options are very expensive. But, it is like totally personal preference. You have to decide for yourself, am I willing to own this stock if I have to buy it?
Seems like it could be risky though, right? Especially with all that volatility. Like, what are the risks involved?
100%. If we talk about if the stock goes way up, look at buying a put. Well, you have to get that timing right and the direction and all that. And then selling the put. If we see something that gets, that's a nice reminder. If we see something that, we always say, don't just chase premium. Right? So don't say, okay, wow, this stock is trading at $800 and I can sell the $400 put for $60. If it just stays above $400 for such and such period, then I make 15%. That's what you want to avoid, because we can see on some of these names that the thing could just go right back to 150, and now you're strapping on a stock that, you might not want to own.
When it comes to a stock right now that has the highest option prices or the most opportunities or possibility, what are you looking at? Are there any names?
Yeah, so SanDisk. So this is one, again, if we look at sort of a 3-month chart on that, you're going to see it's going basically parabolic. So when I priced this out like half an hour ago, the stock was around $1,400. You can go out to June, so June expiry, that's the 18th for U.S. options, and sell the $1,000 put for like $40. So this has almost $400 of downside before you hit that strike, and you're generating 4%. So if you are looking at that stock and saying, hey, memory is where it's at, and I wish I bought this stock on the way up, you can sort of pick last week's price and say that's where I'll enter. And so taking advantage of this crazy high implied vol.
Just before we wrap things, before we go to break here, we kind of talked about this. Lululemon was one example, but how often do you actually get into these more like volatile names?
Not that often, right? It's maybe like we check this every day. We've got our systems in place that we're looking at where we can find some of these things. We're pretty conservative. We're looking at using options for that downside protection and reducing volatility. Mm-hmm. So it's maybe once a year that we actually come across something and the stars align and we say, hey, wow, we can really generate some big premium here, and it's a name that we like.
Still an interesting conversation, though, for sure. Okay, Chris Thom, CEO and Portfolio Manager at Moat Financial. We're going to be right back. We'll be taking your emails and calls right after this. You can call us toll-free, and Chris will answer your questions, 1-855-326-6266. Or you can email us at knowyouroptions@bnnbloomberg.ca, and we will answer your questions on the other side of this short break. Stay with us. Welcome back. It's time now to take your calls and emails here on Know Your Options. So, Chris, we're going to start with an email from Max. And this reads, Chris, what are your thoughts on this option trade on AltaGas, ALA? It says, I own and am happy with AltaGas and would like to add more using this trade. So sold July for $48, put for 40 cents, and then sold July 56 covered call for 40 cents, and then for 80 cents credit.
So this is a great trade. You've got a position on and you're saying, okay, if it goes down, I'll buy more. But if it goes up, then I'll sell it. So you're really saying, if there's a big move in one direction or the other. You'll either double down or liquidate. So I think it's a great way to sort of leg into a position. So instead of buying a full position and then selling a covered call, or not getting long the stock and just selling a put, this is a way you can kind of play both sides and you're collecting more premium. If you're going to be selling that put, though, I just want to make sure that, if we're doing this, we always have that cash set aside to buy the stock if it goes down. So we're not buying the stock with all of the cash that we want to allocate to that position and then selling a put on top of that, because now we're using leverage, and if we're wrong, then it's really going to hurt.
And obviously a company like AltaGas, it could go down depending on what happens geopolitically, right? Like, we're seeing a bit of a rise right now, but you have to keep that in mind.
Yeah, and this stock, I mean, it's not the craziest volatility name, so it's not really fitting the show in that regard.
It's not a meme stock.
But yeah, I think it's a great way to generate more premium on names that you like, and you either end up with more stock or none, or the stock just stays right here and you just keep doing that again and again and again.
Okay. We're going to go to another email. This is from James, and it reads, I have in the past been writing C-covered puts on Shopify and have variously been assigned and subsequently written covered calls against those shares. Most recently, covered calls expiring April 17th with a strike of 200 and a juicy premium. Has Moat any interest in this security? Can you see a strategy here, or does Shop not represent a wide enough moat for your attention?
Yeah, well, good use of Moat several times in that question, so I like it. Yeah, so as far as us, this doesn't meet a lot of our parameters as far as being a value stock. They do make money, they are growing. All of that is good. Their earnings the other day, I think they were okay, but the market didn't really love what they saw, obviously. So, but again, that's not necessarily what we're doing based on our parameters, but if it is a name that you like, the option premiums on this are very high. So it's nice to have a Canadian name that is in the technology space, something that we don't often have a lot of. We have to go south of the border for most of that. So I think it's a worthwhile name. Like, I wish I bought it 5-6 years ago. It's done very well. They did break the cardinal rule of becoming a larger Canadian listed company than Royal Bank, which has ended badly for everyone prior. So, that's it's not for us, but that's not to say it's a bad company to trade options on, because like you said, it's got juicy premium.
Yeah, for sure. Okay, we've got another email now. This one is coming in from Stokes. And short and sweet, it just says, any ideas on how to option Micron right now? Micron doing pretty well this week. What are your thoughts on optioning that company?
Yeah, so Micron, it is right up there with what I was talking about with SanDisk.
Really?
As far as the performance. When you look at the right side of that chart, I'm going to use my little pen here, that's gone from sort of high threes up to 650. So just looking at it again, it's not something that we hold in the Moat Active Premium Yield ETF, but the stock is $660, and you can sell the June 500 for almost $15. Okay, so that's 3% of that underlying strike, but you've got $160 of downside protection. So obviously, if the stock can move up that quickly, I guess there's probably no reason why it can't move back that quickly. But this big move up has pushed the implied volatility on these options to 85. So to put that into context, the implied volatility on the S&P 500 or the VIX is like 17. Okay, so this is 5 times. The options are 5 times as expensive as the broader market. So if it's a name that you like and you want to get into it, you can go ahead and do that at a discount and get paid pretty handsomely for it. Or I guess if we look at the other side of it, if you've been riding the stock up this long and you own it, you can look at the June 800 call and get paid $31. Okay, so that's 4% just about, and you're going all the way up to 800, an area that it's never been before. So if you like it, I say sell some options somewhere.
Okay. All right. We've got another email question. This one is from Brad. Apologies. And it reads, hey, Chris, really interesting chat about meme stocks. What's the strategy with Allbirds? So Allbirds, obviously this company, shoe company, has recently switched to an AI company. Is this a meme stock, first of all? Would you consider it? Probably not.
I mean, it's definitely had a huge move.
Yeah.
I think I don't know the whole story on it. We don't own it.
Yes.
And it actually doesn't trade options, which is kind of interesting. I remember seeing a video on Twitter or X the other day of someone saying, like, can somebody please, get simple to trade options on Allbirds so I can buy some puts, but it didn't have any options. So at this point, I don't know why it's not. It obviously meets a lot of the parameters for volume and interest. And normally in the U.S., especially when something trades huge volume, if they think people will buy options on it, they will list them. But in this case, they didn't. So I'm going to say this is in the, we're not touching it pile for us.
Is that how that works then? Because I was going to ask, how surprising is that for a company not to trade options? Is it basically because of the scale, the size of the company?
It should.
Most of the time?
Yeah, I mean,
Right.
This should trade options. I'm very surprised that it doesn't. In the U.S., you just have to have, I think, 7 million shares that are in the available float, and it has to trade at least 2.4 million shares in the prior 12 months. And if I look at this one, I think it has traded average daily volume here of 19 million shares. So it's meeting all of those parameters. I guess no market maker wants to touch it. I don't know.
Interesting. Well, we'll see with this transition with this company. Maybe things will change.
Yeah.
Okay, we're going to go back to our inbox. We've got an email from Johnny coming in, and it says, what do the options flow and implied volatility in Ballard Power tell us about investor expectations for the clean energy sector?
So I don't know that the option prices can tell us what the market is thinking about the clean energy sector. What I can tell you that the options are implying about this stock in particular is that it has been volatile and will remain volatile. So right now in Canada here, the stock's trading at $6.55, and you can sell the $5 put out to July and get about 30 cents. That's 6% of that underlying strike for 2.5 months. And you've got all that downside protection. I guess looking at this chart, it's up a bunch today in the last couple of days. So if it retraces to where it was on Monday, then I guess you'd be losing money on this. But, it's volatility. The implied vol on these is 85. And all that can really tell you is that the market thinks it's going to either go up or down a lot from here.
Okay. Another email, this one coming in from Ryan, and it reads, what does the options market tell us about sentiment toward discretionary names like Krispy Kreme right now, for example? So, okay. We'll start with that.
That one's DNUT, is that right?
Krispy Kreme?
Yeah. So I guess we talk about meme stocks, and then everybody calls in with the most expensive options you can come up with. So, this isn't a name that we are looking at, but I mean, the options on it are incredibly expensive. The implied volatility on these June options are close to 100. So, stock's $3.75. The $3 put is, you probably get 12 cents for it. So that's 4%. You've got, almost 20%, more than 20% of downside protection. So I think it's important to realize with these that it can be a little bit trickier to trade options on sort of low single digit priced stocks, because the strike prices are so far apart from a percentage wise. It'd be way easier if options traded on this if they did a 1 for 10 rollback and the stock was $37 instead of $3.75. So, the only risk with this one as well is that if it falls below $3, then it does not meet the threshold in the U.S. for carrying on with options. So you could get an option position going and then have a tough time rolling it over if the stock ends up going against you.
Interesting. I mean, when you look at the one-year chart for Krispy Kreme, the volatility is pretty wild. We just had it up. I'm sure we'll pull it up again. Is there better ways, especially if you want to look at meme stocks or more volatile stocks? Are there should you go in with a stock like Krispy Kreme that's just up and down, up and down? Is that not the best way to start? Or if you're just starting out?
Yeah, I mean, for the main thing is always making sure you're comfortable owning that equity, right? And then with these ones with the expensive options, you want to be a seller, right? Buying these options, if you were to buy calls on this, the stock has to move up quite a bit for you to make money. Whereas if you are going to sell puts, then you're not going to hit a home run, but your odds of hitting a base hit or even rounding first into a double here is way higher. So that would be where we would recommend, but it always has to start with wanting to own the business. Or if you're going to buy a fund, make sure that is their philosophy, that they are only trading options on things that they think will do well over time and not just chasing premium to bring in a big fat premium and then hope that just pray that the stock doesn't go down. I mean, that's not the way to go.
Have some logic behind it. Okay. All right. We're going to take a quick break right now, but we'll get Chris Thom's top options trading ideas when we come back. Stay with us. Okay, time now for Chris Thom's top options trading ideas. So we'll go through these. Your first pick is Meta. Tell us why you like Meta as a trading option here.
Right. So Meta, I mean, it is obviously a growth company. It's in the Mag 7 there, but it has pulled back from its highs, right? I mean, they still have 3 of the top 5 apps as far as usage go on Earth, which we think is a decent moat around them with that. But now that the stock's pulled back from its high of about 796 to closer to 600, trading around 21 times earnings. So for us, that's headed into value territory here. We're looking at being fairly conservative with this and going stock at about 615, selling the June 575 cash covered puts, so about 6% below for $10. So that's going to bring in almost 2%. That's, I think, 43 days until expiry. And, our hope is that the stock moves around a little bit, but finishes at or near where it is now, so that we can do it again, instead of the June's expire and then go out to August and so on. So many of the other Mag 7 names have rallied. We sold puts on Apple and Microsoft and all these other names. They've moved up quite a bit. PEs have expanded and Meta hasn't.
And so you say, too, the market seems to be punishing this stock a little bit because of their CapEx spending. So tell us more about why you think that.
Yeah, I mean, they moved their CapEx guidance from, it was 115 billion to 135, up to 125 to 140 billion, $145 billion range.
Yeah.
So I think the market hasn't forgotten about the metaverse. So, Zuckerberg, that was a major cash evaporator machine for them. And I think that it's now actually been shut down. So that was just money that went into the trash. And, the market's probably a little bit worried that he's going to do it again with his AI spending. But I think he's probably learned from that, right?
Yeah.
He's seen how much the market punished them last time. And the stock went down to like $100 last time they went wild with CapEx. So I think he'll be a little bit more controlled, and that should help the stock long term.
Your next pick is Netflix. And you've got a good story to go along with why you picked Netflix and your history with it.
Yeah, so Netflix, we are recommended selling the $82 June cash covered put. For this, we can get about $1.40. So, yeah, people might remember that back in February, we recommended selling the March 13th $78 cash covered put. That was a week before the vote for Warner Brothers was happening. So we tried to get a little bit cute with it so that we could do it again before the vote. But then obviously Netflix pulled out and the stock rallied. I think it might have even got to $100 in that rally. Yeah. But now we've seen it drift back a little bit below $90. I think it's about 88 right now. And if we can collect $1.40 over that same 43-day period as we were talking about with Meta, if we're forced to buy it at 82, we'll be happy. But otherwise, we're hoping it kind of drifts around this range and we can do it again.
And lastly, at Cameco, it sold June for $130 cash put for $2.15. So tell us more about this one. Yeah, so this one here, I first priced it out to sell the 130s. Then the stock's up like $11 or $12 today. So had to rewrite this one. So we're going to sell the June 140 cash covered put for about $2.50. So again, this is getting close to 2% of that strike. And we got 17% downside protection. We think, uranium is a great place to be, and they are obviously a market leader, and we've got some downside protection, but we can generate some good premium in there. Okay, we've got to end it there. Thanks so much for coming in. That wraps up this edition of Know Your Options, and Chris Thom will be back in 2 weeks on this show. Stay with us.